It will be very interesting to discuss about risk management because with the integrated business ecosystem, whether a financial entity or a non-financial entity is constantly threatened by the onslaught of risks. Some of them are known risks, some of them are unknown risks. The threat is more if the risk is unknown. Now, what is risk? Risk is potentiality of loss arising out of adversities in the business ecosystem. Now, risk is something which needs to be apprehended and which needs to be managed with systemic controls in place. So, in order to understand the risk management systems, we need to understand what is risk. So, in one word, risk is loss arising out of uncertainty. Now, uncertainty is something which cannot be tackled without probability theories, without applying law of probability, that what will be the probable certainty amid uncertainty. So, risk management is all about how to reduce the impact of uncertainty on the business operations. Now, whenever we talk of risk management, we immediately get connected with the financial losses arising out of risk, but it can be any kind of loss and it can stretch to any line of business. So, today we will talk about the financial risks. Now, financial risk is arising out of a reduction in the potential income out of financial intermediation operations. Means any financial intermediary would like to make money from money, that is the financial intermediation. If it is so, then how to prevent losses to the organizations which are arising out of the uncertainty. So, there are the concept of risk was there centuries ago also, and people used to manage the risk in the way in which it was possible at that point of time to be managed. But with the integration of markets, with the integration of the different kinds of business operations, the risks have started manifesting in a big way. And now that we have technology with us, the data about the operations, we are in a better position to manage the risk. Now, with the advent of technology, with the advent of data analysis, with the availability of data tools, we are in a position to project what will be the shape of things to unfold in future with certain degree of confidence. That is why we are harping on management of risk. Now, there are straight tools as far as risk is concerned. Insurance is one tool. Normally, insurance is taken for the kind of risks which cannot be managed. And there are certain kinds of risks which we do not want to entertain. So, we exclude them from the purview of our business operations. But there are certain kinds of risks which we can manage, and those kinds of risks are business risks which an entrepreneur takes to make money. So, in the League of Financial Risks, the Basel Committee, which was set up in 1930, and it is a conglomeration of central banks of different countries. As of now, there are 60 central banks which are forming part of the BIS, that is Bank for International Settlement. It has formed what is known as Basel Committee, that is Basel Committee for Banking Supervision, that is BCBS, Basel Committee for Banking Supervision. So, this committee has for the first time given a framework which is known as Basel Committee 1. It has come out with a concept of credit risk, that is the one kind of risk where the default can happen. Because financial intermediation is a kind of business where we take money from those who can save and provide that money as loan to the entrepreneur to make money and return the loan with interest to the financial entity, so that the money can be returned back to the depositor safely. That is the whole operation. But most likely in certain situations, the money which has been given as loan may not come back to the financial entity, that is a bank. In that case, how to cope up with the situation, because the bank will be saddled with what is known as bad loan, that is broadly known as, categorized as credit risk. Credit risk is a default risk, is a counterparty risk. There are various kinds of risks, but the most important risk for a financial entity is the credit risk, because the money that is mobilized from the depositor cannot be held in the bank or the financial entity. If it is an NBFC, we can't hold it. We will have to deploy it either in the credit or in the investment to earn money, so that we can give interest to the depositor. That is the cycle of operations. In this, the bank will be exposed to credit risk. That is the big chunk of risk, because the risk can be assessed from the balance sheet of the entity. If you look at the balance sheet of a bank or an NBFC, you will find that most of the funds which are taken as deposits are subject to the statutory liquidity ratio and cash reserve ratios, are deployed in credit, and some of course in the investments. So, the biggest chunk of risk is credit risk, because the biggest portion of assets belong to the loan assets. If you have higher loan assets, you have higher propensity to lose money from the delinquent borrowers. So, if there are delinquent borrowers, the bank or the financial entity will be losing money on account of bad loans. Now, if it is so, the Basel Committee has given a framework after a lot of research that the banks need to keep capital to withstand the losses arising out of credit default. 8% is the minimum capital which is required and which is recommended in Basel Committee 1. The local regulators, that is the host country regulators, that is the like India, we have Reserve Bank of India, it can prescribe a capital adequacy ratio higher than the minimum capital required recommended by the Basel Committee. For example, in India, though the Basel Committee recommendation is for 8% of risk weighted assets, we have 9% of the risk weighted assets. So, we need to maintain, the regulated entities in India are required to maintain a 9% capital adequacy ratio. So, this will give a cushion to the banks to meet the unexpected eventuality of losses arising out of loan losses. It is only in 1997 that the concept of market risk was added to the inventory of risks identified by Basel Committee. So, put together, Basel Committee 1 has dealt with credit risk and market risk. Market risk is that kind of risk which arises out of adverse volatility of securities which the financial entity might have subscribed or where the investment was made. Any financial entity for that matter will be exposed to market risk because it has to run its treasury operations, that is the day-to-day maintenance of cash requirements, inflows and outflows. So, any financial entity will be automatically exposed to credit risk and market risk. That is the concept which has been put under Basel Committee 1. In 2003 and 2004, Basel Committee has given Basel Committee 2 another framework, bringing the concept of operational risk into the framework of the banks. Operational risk is omnipresent and omnipotent. Operational risk is the loss arising out of any unexpected events, which is very difficult to measure or mitigate. Credit risk, we know what will be the assets from our balance sheet. We know the investments from our balance sheet, that this is the amount that we have invested. But as far as operational risk is concerned, there is no barometer which is reflected in the form of assets. So, operational risk is a much more risky risk, I would say, because the impact that it can make and the vulnerability that it increases to the financial system is very, very huge. So, to sum it up, I would say that the risk of the financial entities is broadly categorized into credit risk, market risk and operational risk. Credit risk is the default risk, market risk is risk arising out of adverse movement of value of securities in the market, and operational risk is any kind of risk which causes any loss to the organization other than credit and market risk. Of course, going forward we will see how we need to deal with each kind of risk, how to identify, how to measure and how to mitigate and work out strategies to manage risk in our financial entities. Thank you very much.